Demand is very good, 1.4 million barrels a day we're forecasting for this year. And supply, as you say, is growing, but the demand is offsetting that. So we're going to end up with a 0.6 implied stock draw this year, which is enough to rebalance the market. It's enough, more importantly, to move OECD stocks, which is what OPEC are looking at, away from these lofty levels where we are now, down towards the 5-year average, which will then define the market as being rebalanced. And our view at that point is that that then flips the Brent forward curve into backwardation, which is a very positive profile in the asset class for investors, because then they have what's called a positive roll yield. So that will then lift all other commodities. So looking out across over the year, it's the demand both in metals and oil is pretty positive.
So what are some of your trade recommendations right now?
We think you need to buy oil, specifically Brent, specifically the December 17 contract. And the reason for that is it's further down the curve and offsets a lot of this negative roll yield. We suggest buying copper, buying zinc, selling gold, selling cotton, buying cattle.
Why selling cotton?
Selling cotton because we've got ourselves into a particularly tight situation at the moment with prices around 70, 78, 79 cents a pound. And there's talk that China might be releasing their state reserves of cotton. We've got nice supply coming out of India now after a bit of a tight period. Good supply in Australia. And the market is extremely precariously positioned in terms of the hedge fund positioning. So there's massive long position, very small short position. So any fundamental wobble on that, which looks like it's going to come, could translate into a pretty powerful exit of these speculators.